The crypto bear market is here. Or at least that's what clickbait news headlines would have you believe. It's no mystery that the crypto market has been moving sideways since mid-May, and sometimes it does feel like we might be on the brink of another big crash that begins the bear market. Other times, it seems like the bull market is about to spring back to its feet and sprint to new all-time highs. It's wise to have a bullish bias in a bull market like this one, but the truth is that a bear market is somewhere on the horizon. Although the bear market might not be here yet, it will come eventually. But when? How will you know when we're in a bear market? How can you prepare for it? What even is a bear market? Now, if these are the sorts of questions that have been bouncing around your brain, then this video is for you. I know you're eager to start, but diving in without a disclaimer wouldn't be smart. You need to know that I can't help you with your financial matters. This video is just for your education and entertainment, so if you need help with your money, then please consult a financial planner. If this is your first time here, my name is Guy and crypto is my career. The Coin Bureau is where I create the highest quality crypto content you'll find anywhere on the internet. Coins, tokens, news, and reviews. I keep the hype to a minimum and focus on the truth. As the saying goes, knowledge is power. So if you want to increase your power level, subscribe to the channel and ping that notification bell to make sure you get this content on the hour. Your time is priceless, which is why I've left timestamps in the video timeline so you can see today's topic list. Feel free to skip ahead if you see something that catches your eye. Remember though that watching the whole way through will make it easier for others to find. Now that we're on the same page, let's get into the crypto market's bear phase. Every single asset has its own market cycle of booms and busts. While each asset's market cycle tends to vary in length and volatility, all of them follow a similar pattern to this famous photo, the so-called Wall Street cheat sheet. As the photo suggests, the fundamental reason why the price of an asset goes up and down in the short term has to do with human psychology, specifically human emotions like fear and greed. This is why even fiat currencies fluctuate in value every day. They're not really stable. It's just that the degree to which fiat currencies fluctuate is often small enough that they can be considered stable. Even then, there's an entire foreign exchange market where traders make millions of dollars off percentage in point changes, or pips, in various fiat currencies. That's 1/100th of 1%. Now, by contrast, cryptocurrencies can change in value by hundreds and sometimes thousands of percentage points per day. This puts them on the opposite end of the asset volatility spectrum. The reason why cryptocurrencies are so volatile is because nobody knows for sure what they're actually worth. Take a cryptocurrency like Ethereum, for example. Ethereum makes it possible to do things like lend, borrow, and save money without a middleman like a bank, and all you need is an internet connection to access these services. There's even something called a flash loan that lets you borrow over $20 billion of cryptocurrency for 15 seconds with zero collateral and zero risk. You just need to pay a small network fee. Now, what kind of price tag do you put on a technology like that? Some would argue that cryptocurrencies are worth more than all the money in the world since they exist to replace the financial system. Others say that cryptocurrencies should be worth at least as much as their real-world equivalents as they slowly take on similar roles in certain regions of the world. A few still insist that cryptocurrencies are nothing more than a Ponzi scheme, and to be fair, some cryptocurrencies are nothing short of that. These mixed messages result in mixed emotions for the average trader, who typically buys and sells cryptocurrencies based on how they feel. This is actually the basis of technical analysis trading, and you can start learning about it by watching my first technical analysis tutorial using the link up there in the top right. Besides human emotions, there are also macro factors at play, which influence the ebb and flow of any given asset market. These tend to have a much larger impact in the long term. According to famous hedge fund manager Ray Dalio, the most important macro market factor is something called the debt cycle. This debt cycle is broken down into two phases: a short-term debt cycle, which lasts 5 to 8 years and ends in a recession, and a long-term debt cycle which lasts 75 to 100 years and ends in a depression. I'll leave a link to Ray's own explanation of the debt cycle in the video description if you're interested, but the TLDR is basically this. Borrowing money creates economic growth in the short term. Individuals typically use borrowed money to buy more stuff. Corporations use it to create more stuff, and governments use it to fund more programs. This creates a bull market for most asset classes, a sustained, long-term uptrend in price. Higher highs, lower lows, all that fun stuff. Eventually, that debt piles up, and all these individuals, corporations, and governments need to start paying off some of that debt. This requires a reduction in spending. This reduction in spending means that individuals buy less stuff, corporations make less stuff, and governments cut back on their programs. This creates a bear market for most asset classes, a sustained, long-term downtrend in price. Lower lows, lower highs, definitely not the fun stuff. If you look at the price history of a big stock market index like the S&P 500, you can clearly see this debt cycle in action. From 1997 to 2002, from 2002 to 2009, from 2009 to 2016, and from 2016 to whenever this cycle ends. Note that I'm counting the end of each cycle from the start of each bear market, not the bull market peak. What's interesting is that when you compare cryptocurrency's previous market cycles to the stock market, you can see a surprising degree of correlation. In other words, whenever the crypto market was reaching its highs, chances are the stock market was doing something similar and vice versa. Now this makes sense because we live in a globalized world where all assets are linked in some way, even more so for cryptocurrency since 2017, when the institutions got exposure via Bitcoin's CME futures. Case in point, Bitcoin hit its highest correlation to the stock market last year. Now, why does this matter? Well, it means that the cryptocurrency market will probably see its bear market around the same time the stock market does. The stock market's price history suggests this will be sometime in mid-2022, and this happens to correspond to what cryptocurrency's own market cycle is signaling. As most of you all know by now, the cryptocurrency market follows a 4-year cycle that seems to be caused by the Bitcoin halving, which, surprise, surprise, occurs every 4 years. The halving reduces the amount of newly mined BTC by 50%, and this reduction in supply, coupled with a gradual increase in demand, means BTC goes up in price. Because almost every cryptocurrency is correlated to Bitcoin, the rest of the market responds in kind. The last Bitcoin halving took place in May last year, and assuming history repeats itself, this means the top of this bull market will happen sometime this summer or in the early fall. If you want an in-depth video of how to spot the top of this crypto market, you can watch my video about that using the link up there in the top right. Anyways, after the crypto market top, we will see a big crash, and then about a year of gradual price decline until we hit the bottom of this current cycle. To clarify, this decline is the start of the bear market, and the bear market bottom should be sometime in the summer or fall of 2022. There are just 2 caveats here. Firstly, there is a chance that this cryptocurrency bull market continues indefinitely into the future, as all the cryptocurrency coins, tokens, and technologies swoop in to replace the current financial system. This is called the cryptocurrency market supercycle, and even though it is possible, it's not very plausible. This is simply because it's logistically impossible to accomplish something like this in such a short period of time. The adoption of cryptocurrencies has been and will continue to be a gradual process with lots of hurdles and red tape. That said, cryptocurrencies could see a supercycle in fiat terms because of hyperinflation. This is arguably more likely than an adoption-driven supercycle. Governments around the world have been printing currency like mad, and the inflationary effects of this are only just beginning to surface. The thing is that just because the prices of Bitcoin and Ethereum are in the hundreds of millions of dollars in paper terms, it doesn't necessarily mean that the purchasing power of BTC or ETH has gone up. Bitcoin and Ethereum could technically be in a bear market, but still be increasing in nominal terms just because the value of money is going down due to inflation. This inflationary effect has probably played a role in the so-called bubbles in housing, stocks, and cryptocurrencies we're supposedly seeing. I'll leave a link to my video about inflation in the video description if you want to learn more about that, and I recommend you check it out when you get a chance. The second caveat involves the possibility that the next crypto bear market will last a lot longer than a year or two. As I mentioned earlier, the long-term debt cycle lasts between 75 and 100 years. Assuming this model is correct, a depression could be around the corner. This is because the last depression took place in the 1930s, which was around 90 years ago. Some economists have argued we are in a depression already because of the pandemic. Others insist that the depression should have happened in 2008, but that governments have managed to keep kicking that can down the road by printing money like mad. A few even believe that there will never be a depression again because of our magical modern monetary policy. When the depression inevitably happens, history suggests that it could last as long as a decade. Again, the next depression could be many years away, and there's no guarantee it will happen, but this is something you need to keep in mind when planning for the next crypto bear market. On that note, let's take a look at how you can prepare for these different bear market scenarios. To quickly recap, there are three possible crypto bear market scenarios: a regular bear market, a hyperinflation bear market, and a depression bear market. Regarding a regular bear market, I'll start by saying that if you're in crypto for the long run, you're better off hodling what you have and adding to your position on a regular basis. This is called dollar cost averaging, and it is statistically the most successful long-term investment strategy regardless of the asset. If you're looking to ride the wave, the first thing you need to understand is that it is extremely unlikely that you will buy the absolute bottom of the next bear market. Where that bottom will be is anyone's guess, and my personal guess is that the bear market bottom will be somewhere in the 20 to 30k range, assuming we have a regular bear market. On the way down to the bottom of the bear market, we're going to see a series of bull traps. This is where the price suddenly spikes in the short term before continuing its collapse. The easiest way to filter out these bull traps is to set the price chart to monthly. This will give you a better view of the longer-term price trend. In terms of entry, what you'll be looking for is a clear trend reversal. Now, using Bitcoin's previous bear market as an example, this was around the $6,000 mark in May 2019. Note that I'm now on the weekly chart. While it would have been ideal to get in at the $3,000 range, there's no way of knowing if that was really the bottom, and you'll be kicking yourself if you go all in at that price and it keeps dropping. It's better to be on the safe side and wait for that reversal, especially if we're dealing with the other two bear market scenarios. In a hyperinflation bear market, the price of cryptocurrencies will probably go through the roof, but their purchasing power will decrease. This might sound surprising because it's often said that assets like Bitcoin and gold thrive under these inflationary conditions. Apparently, this is not all that accurate. A financial YouTuber called Star Path Academy recently made a series of videos about the value of precious metals during the hyperinflationary period in Romania in the 1990s. At the time, the annual inflation rate of the Romanian lei was well over 100% and even went over 200% for 2 straight years. Gold and silver were not used as mediums of exchange, and this was primarily because most people didn't have any gold or silver. Those that did hold gold and silver understood that precious metals are the best way to store your wealth long term, so it was often the last thing they sold. This ties into something called Gresham's law, which states that people generally use the least valuable form of money they have to buy things with. Anyways, the practical effects of this precious metal hoarding meant that whenever someone did sell gold or silver, this meant they had nothing left to sell. The person buying could therefore offer a much lower price than what the gold or silver was really worth because the seller was desperate. Now, this consequently crashed the value of gold and silver relative to other assets that were used as currency in Romania at the time, such as food, livestock, building materials, and tools. What this means is that if we enter some sort of bear market hyperinflationary period, the last thing you'll want to do is buy or sell your cryptocurrencies based on their fiat value. Instead, you'll have to do your best to estimate how much value your cryptocurrencies have relative to other assets that you actually need or want, and buy and sell your crypto based on that information. By that point, I reckon you'll have bigger concerns than buying the bear market bottom. And this will probably also be the case with the third bear market scenario. If the next cryptocurrency bear market ends up being part of a global depression, it will make for an amazing dollar cost averaging opportunity, assuming you have the funds to spare, of course. The problem with spotting depressions is that you don't know you're in one until much later. Typically, they start off like a regular recession/bear market, and that means a big old crash and lots of lost jobs. Although the crypto market hasn't gone through a depression before, history suggests that it won't hold up too well, and the price could continue to drop for years. This is because people tend to buy two types of things during depressions: the things that they need to survive and things that take the edge off. Cryptocurrencies don't fall into either of these categories. The things that do fall into these categories are shelter, energy, clothing, food, water, and, interestingly, alcohol, cigarettes made of various plants, news media, and even entertainment like movies and TV. All the companies that provided these much-needed outlets during such stressful times fared pretty well during the Great Depression, and some of them even managed to grow during this period. The only cryptocurrencies that could potentially provide the same outlet are those that power virtual worlds like Decentraland, and those that are used in esport and video games like Engine Coin. Now, something tells me that people won't be too eager to spend their limited funds on some sort of in-game NFTs, but I could totally see people gambling their crypto in Decentraland during the next depression. You can learn more about Decentraland by watching my video about it, and you already know where to find that link. Yes, you do. Yeah, well, top right, if you forgot. The thought of a crypto bear market might make you worry, but it's a normal and necessary part of every asset's market cycle. This is easy to forget when you're used to seeing your favorite cryptos consistently go up by double digits on a weekly basis. The last month of choppy price action might make you feel like the bear market is here, but the global and crypto macroeconomic factors suggest that this is not the case. Assets are continuing to rally across the board. And even though there is some volatility in the short term, the long-term upward trend continues. What comes up must come down, though, and 2022 seems to be the year when that decline begins. The real question is how hard the next bear market will be on cryptocurrencies. The good news is that cryptocurrencies have seen enough adoption that they are likely to survive every type of bear market scenario on the table. A regular bear market would be ideal, but I have a gut feeling that we might end up with one of the more severe bear market scenarios. I lean towards a hyperinflation bear market because it would be a convenient way for governments around the world to transition their populations to central bank digital currencies. Governments probably know they can't convince their citizens to give up their cash, but they can devalue it to the point that people start looking for alternative forms of currency. You could argue that cryptocurrencies would fill this void, but the fact of the matter is that there is no cryptocurrency on the market today that is ready to become the planet's payment network. Now, for what it's worth, I'd much rather have a dystopian CBDC than a world war, which seems to be what ended the last depression. No matter what happens, though, I plan to hold on to my Bitcoin for dear life. With some luck, I'll have enough stashed away to deal with whatever bear market scenario comes my way. If you learned something new today, smash that like button to make my day. Subscribing to the channel and pinging that notification bell is a great idea too. You can even follow me on social media if you want to stay in the loop. I've got a Twitter, TikTok, Instagram, and even a free Telegram channel where I give you my take on the crypto market every day. If you're into newsletters, and who isn't, I happen to have one myself. It's jam-packed with everything you need to know to supercharge your crypto portfolio. You even get to see mine and how it changes from week to week. If you're a real crypto freak, head on over to the Coin Bureau merch store to get some awesome crypto tees and hoodies. I know you want to join the 21 Million Club. Links to all of these resources are in the video description. You can't miss them. That's all I've got for today, folks. Many thanks for watching, and I'll see you all next time.